Hi guys, welcome back to my channel, Kelvin here. So, in case you haven't heard, there's a potential war between Russia and Ukraine about to happen. Some of you may not know this, but I've been in a lot of wars, like in Red Alert, Call of Duty, some outer space wars, and most recently, the Titan War. So, you know, I'm something of a war expert myself. That was a joke by the way, if you didn't get it. Right now, you'll be like, ayo, first it was the pandemic, then high inflation, then lower tech earnings, and now war? Since the beginning of 2022, the market has already went down like 6.7%. So, in this video, I want to explain how wars will affect the market and how you should invest during this period. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a bear riding a sidecar in Russia. Alright, let's start right now. First up, let's talk about what triggered this whole Russia-Ukraine war situation. So, as you know, last time Russia used to be the Soviet Union. If you don't know, now you know. In 1991, the Soviet Union collapsed due to a lot of reasons like political factor, economic factor, military factor, and so on. And from this collapse, 15 independent countries came out. The biggest one obviously is Russia. Then you have the smaller countries like Estonia, Latvia, and so on. Since then, there have been a few ex-USSR countries joining NATO, like Estonia, Latvia, Lithuania. Okay, maybe you'll be like, huh? NATO I know lah, that one can eat one. But what's NATO? NATO, or North Atlantic Treaty Organization, was created after World War II. It's an alliance between Europe countries and the US to protect themselves against, you guess it, USSR. Their motto is, the parties agree that an armed attack against one ally is considered as an attack against all allies. So just think of NATO like if you gonna bully, you'll be like,
started tomorrow, 4 p.m. at Pioneer Mall.
Then you go and call all your friends to whack the bully. This is a bit like the teenager version of NATO. So anyways, what happened was that there were more and more ex-USSR countries joining NATO. And most recently, Ukraine also wanted to join NATO. It'd be like, let me in, let me in. When Russia saw this, they immediately be like, don't join, later I whack you. And that's basically what is happening right now. Okay, here's why Russia is acting like this. Since the start, when ex-USSR countries joined NATO, Russia was already not happy. Because in 1990, NATO has promised not to expand an inch to the east. But guess what? They expanded. Russia then wanted NATO to return the pre-1997 borders. But NATO be like, no, we don't do that here. As Russia previously took over Crimea, which belonged to Ukraine, Russia is scared that if Ukraine ever joins NATO, NATO will help Ukraine take back Crimea. So, to avoid that, Russia is threatening to take over Ukraine first before Ukraine can join NATO. And so, it has led to the current war situation. Of course, this whole situation is more complicated than this, but this is just a summarized version, yeah. Since then, Russia has started moving its armies around Ukraine. And Ukraine president wanted there would be attack on February 16, and it didn't happen. Meanwhile, Ukraine government websites and banks were hit by denial of service attack and went down. Just in case you don't know what's DOS, basically it's when Singaporeans rush to buy plane tickets, causing Singapore airline website to crash. Same thing, you guys just DOS attack your own SIA website. Anyway, on 16 February, Russia announced that they will be withdrawing their troops. So the war is over? Not really. Because rather than withdrawing, US found that Russia has been adding even more troops, so the war can still happen. Okay, now that we are up to the latest episode of the Russia-Ukraine war arc, here's an important question. How will the war affect the market? Here's the most basic rule that everyone knows. Bad news, market red. Good news, market green. When the war seemed like it was about to happen on 16 February, the markets went down. And when Russia said that they were withdrawing troops, the markets went back up. That's obvious, right? Bad news, market down. Good news, market up. So simple. But what is the long-term effect of the war on markets? Let's look at some past data because science. First up, World War I. When it first started in 1914, the Dow Jones dropped by a godlike 30%. But by 1917, when the war was still ongoing, the market be like, this is fine, and actually went up as high as 80%. By the time the war ended in 1918, the market still gave almost 50% return since the start of the war, and quickly went back to all-time high in 1920. Next, World War II. At the start of the war in 1939, the market be like, meh, and didn't react much. Then, when Pearl Harbor was attacked in 1941, investors be like, sell crash However, similar to World War I, here's something interesting. During the middle of the war, the market started going back up. And by the time the war ended, the market gave almost 50% returns. Next, Korean War. Right at the start, the Dow dropped by 5%. And again, when the war ended 3 years later, it gave almost 50% returns. So, as you can see, there's a pattern happening over and over again. When the war just started, the market will usually react badly because there's uncertainty. But after a while, everyone got used to the war, and the market continued going up as usual because storms. For example, Vietnam War, at the start, small crash, then the market went up by a lot. Afghanistan War, which lasted over a godlike 20 years, at the start, small crash, then the market went up by a lot. And all this is quite surprising, right? Like, war, scary stuff, war. Why is the market still going up during that period? Here's the reason: uncertainty. Whenever there's sudden stuff, the market will usually go down because paper handlers will usually be paper handlers. Like right now, nobody knows if there will be a war or not, and that uncertainty causes the market to go down. But once everything is certain, things will slowly go back up. Everyone be like, oh no. Anyway, check this out. Whenever there's market shock events, like Iran general got airstrike, US terrorist attack, North Korea go and attack South Korea, the market will always fall. The worst was during the Pearl Harbor attack, where the total drawdown was negative 19.8%. But the average drawdown was only negative 5%, which is just your normal day of holding Tesla or Bitcoin. And after a while, the market has always recovered. The most number of days was during World War II, where it took almost 1 year to recover. And the average number of days is just 47 days. It is also important to note that during the war, the market is not affected by only the war itself. There are also many other factors. For example, during the 20 years Afghanistan war, there was the 2008 global financial crisis and the 2020 pandemic, which caused the market to crash. Or during the Vietnam War, the government decision on war funding caused inflation, which led to a mild recession in 1970. So the drop here wasn't entirely caused by the Vietnam War. Okay, the moral of the story is, as long as there's no sudden events or there's no escalation period, the market will eventually continue climbing up. Now that you know that before a war happens, the market will usually go down, and after that, the market will continue going back up. What can you do? I know, we can time the market. Well, yes, but no, because unless you are the god of gambler, Vatko, you will never be able to time the market because of this guy. This guy will immediately pound the market right after you sell. All jokes aside, here's why trying to time the market is a bad idea. JP Morgan found that if you had been fully invested from 1997 to 2016, the market would have given you almost 7.7% returns. However, if you had tried to time the market but missed out on the 10 best days out of 20 years, your return would only be 4%. Or if you miss the 20 best days, your return drops to 1.57%. Miss 30 best days, and you will start getting negative returns. Now, what makes it harder to time the market is that 6 out of the 10 best days usually happen within 2 weeks of the 10 worst days. Like when everyone is super duper scared, or the market suddenly goes back up to the moon. For example, when the market was crashing left and right in 2020, it suddenly made a U-turn and started going back up. The 3 best days in the market happened right after the big crash. So, panic seller? No. Diamond hands. Then some of you be like, oh, Warren Buffett says be greedy when others are fearful. This means I can start buying meme stocks and what big? No, the basic rules still apply. Don't go and anyhow buy some random stock because that's called gambling. If you are investing your money, you need to buy good stocks. You know, stocks of companies that are earning money, have good future plans like Apple, Google, Amazon. Those kind of stocks, yeah? It's super duper important to invest properly, especially during this period, because right now inflation is expected to go up and many investors will stop investing like an ape. That's why you see many stocks have been going down recently. Additionally, many good stocks have also started dropping because investors are expecting lower earnings from now on.
Drop. I can feel it.
So take this chance to buy good stocks at a huge discount, yeah? Because as usual, as long as you buy good stocks and hold over the long term, you'll be alright. Anyway, that's all for today. Comment down below and let me know, how are you investing during this uncertainty? Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.